Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing MongoDB stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Let's get started with the model. This is a large cap company, 28 billion market cap. They're trading at $3.95 a share, and they have 72 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They do have negative free cash flow each year, although in the trailing 12 months it's positive 89 million. That's a big win for this company to have positive free cash flow. Net income is the profit or loss on the income statement. It's revenue minus expenses. That's negative every single year. Revenue is a sales for the company, and that can never be negative. You can see it has a pretty nice growth from 600 million to 1.6 billion. It grew almost 50% in 2021 and almost 50% in 2022. Then another 24% into the trailing 12 months. We estimated 4 years of future free cash flows. We also estimated the terminal value, it's all cash flows past year 4, that's 13 billion. We discounted the numbers back to today using the weighted average cost of capital. We get a value of the company of $11.5 billion. We divide that by 72 million shares. And we get a calculated stock price of $159. They're trading at $3.95, so they're trading at a 148% premium. It's a whopping sell according to the model. There are 146 companies in the same industry as MongoDB, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They don't spend much on CapEx, only $4 million. Their debt-to-equity ratio is between the median and average, 1.2. That means for every dollar of equity, they have $1.20 of debt. They don't pay a dividend. They're generating positive free cash flow for the first time, 89 million, better than the median. They rank 11th in market cap at 28.5 billion. Really weak price multiples, a lot worse than the median. They're generating a good amount of revenue, still lower than the average, but they're growing like hotcakes. Their 5-year annual revenue growth rate is 46%. The only company bigger is Zscaler. Actually, Block is also a little bigger. They're 47%. Let's take a look at their most recent 10Q. Here's their income statement. The 3 months ending 10/31/2023, 3 months ending 10/31/2022, and this is the 9 months ending 10/31/2023 and 2022. So revenue is up nicely, 333 million to 433 million. A lot of their revenue is subscriptions, 418 million. Services, 15 million. 265 million of their revenue is in the Americas, 119 million in EMEA, Europe, Middle East, and Africa, 48 million in APAC. And that's up in every single category. Here's another breakdown of their revenue. MongoDB Atlas, 286 million. Other subscriptions, 141 million. Services, 15 million. MongoDB Atlas is their multi-cloud DBaaS, database as a service offering. So companies pay a subscription to use this product. So their customers pay a monthly subscription to use this product. Several thousand companies use MongoDB. Toyota, Uber, Lyft, Coinbase, Expedia, lots of really big names. In order to get this $418 million of revenue, the expenses directly tied to the $418 million are 88 million. To get the 15 million of service revenue, the expenses tied to it are 19 million. So they lose money in services. You could think of this as a loss leader. They may need to provide these services in order to get customers to subscribe. So it's well worth it to lose a few $1 million in order to get 418 million of revenue. A solid gross profit of 325 million, but their operating expenses are pretty high. 190 million of marketing, R&D 128 million, both up from last year. Then you have G&A 50 million. So their expenses are higher than their gross profit, so they have an operating loss of 45 million. Better than last year of 82 million. So that gives them a net loss of 29 million compared to 84 million last year. And they're adding shares. Last year they had 69 million shares outstanding, now they have 72 million. Let's look at their balance sheet. 2.3 billion of assets, current assets, less than $500 million of current liabilities, so their current ratio is above 4. So they're very liquid. They have almost 2 billion of cash and short-term investments, 271 million of accounts receivables, deferred commissions, 87 million. They have salespeople that get new customers, and that salesperson will earn a commission. Instead of putting the entire commission on the income statement, which could make their expenses really high in one period, they spread those expenses out over that customer's lifetime. Say a customer signs a 5-year contract and the salesperson's commission is $50,000. They would spread that commission over 5 years, $10,000 a year. So the expense would hit the income statement over 5 years. It kind of smooths out your expenses. But the salesperson may receive the entire commission up front, or maybe half up front and half after maybe a year. But they spread the expense over 5 years, in my example. They have $70 million of goodwill. Goodwill is the premium you pay when you acquire another company. Let's see what they say about goodwill. In September 2023, they acquired the assets of Grainit for $15 million. Grainit is a stream processing application, and the transaction is intended to accelerate the development of the company's stream processing offering. Their largest acquisition was in 2019 when it acquired Realm for $39 million. So their total assets $2.7 billion, up from $2.6 billion. Total liabilities $1.7 billion. Their biggest liability is convertible debt. That's $1.1 billion. The interest rate on this convertible debt is really low, 0.25%, and it looks like the notes mature in 2026. So hopefully the stock price goes up a lot and the debt converts to equity, so they don't have to pay back the debt. If you take their assets minus their liabilities, you get their equity of $1 billion. And they raised $2.6 billion from selling their business. They lost $1.7 billion from running their business. Let's look at their statement of cash flows. This is for the trailing 9 months. So even though they had an accounting loss of $120 million, they actually generated $67 million of cash flow. That's because they paid out $333 million in stock-based compensation. That's an expense that brings down your net income, but we add it back here. They don't have much going on in their investing section, only $3.3 million in PP&E. These big dollar amounts, the $1.2 billion, is when they purchase marketable securities. So instead of sitting on cash, they purchase corporate debt or commercial paper, so they earn a little interest on the cash. In their financing section, they receive $5 million from the exercise of stock options. They received $20 million from employee stock purchase plan, and they paid back $4 million on financing leases. Let's look at a stock on Simply Wall Street. Its last price, $395, $28 billion market cap, down 1% in the past week, up 77% in the past year. Let's see what they say about the company. They offer MongoDB Atlas, a hosted multi-cloud database as a service solution. MongoDB Enterprise Advanced, a commercial database server for enterprise customers to run in the cloud, on-premise, or in a hybrid environment. And Community Server, a free-to-download version of its database, which includes the functionality that developers need to get started with MongoDB. They also offer professional services, as we saw on the income statement. They used to be known as 10gen and changed their name to MongoDB in 2013. They were incorporated in 2007, headquartered in New York City. They IPO'd in 2017 at $30. They peaked at $570 in 2021. It fell below $150 in 2022. That's a pretty big drop off. But the stock has tripled since this bottom in 2022. Simply Wall Street's valuation is $223. They say the stock is 78% overvalued. 31 analysts priced this stock at $460. The revenue forecast looks pretty bullish. Their revenue projection for 2025 is $2 billion, 2026 $2.6 billion. This red line is their debt, the blue line is their equity. So you can see their debt is usually higher than their equity. $1.1 billion of debt, under $1 billion of equity. But don't fret, this green line is their cash, which is higher than their debt, a lot higher. The CEO's annual salary is $400,000, total compensation $13 million. His tenure as CEO is 9.3 years. In the past year, lots of insider selling, no buying. About 60,000 shares have been sold by insiders in the past year. 90% of the company is owned by institutions, 7% by the general public, and 3.5% by insiders. The biggest shareholders: Vanguard, then BlackRock, Fidelity, T. Rowe Price, Jennison, Capital Research, JP Morgan. Dwight Merriman, the co-founder of DoubleClick, owns 2.5%. Morgan Stanley, Invesco, Geode. Amundi, the French asset manager. Scotia, the Canadian asset manager, owns 1%. Gilder, Gannon, Howe & Co. The New York City brokerage firm owns 0.7%. Their employee count has gone up a lot from 754 in 2017 to 4,800 by the end of 2023. The ticker trades on the Nasdaq, Deutsche Börse, London Stock Exchange, Mexican Bolsa, and Sao Paulo Bolsa. So let me know what you think. Give the video a like, subscribe, or comment below. If you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.